The dollar versus Canada moved modestly higher in trading this week, modestly because the range was only about 75 pips from the low to the high. The low was reached on Monday. The high was reached late yesterday. I'll go to the technicals that are driving this currency pair. What happened, what didn't happen, what can we look forward to next week, where are the risks, where are the targets. I'll talk about it in this video, so let's get started. Looking at the hourly chart to start off with, if I put a box around the trading range this week, the low price was, like I said, reached on Monday. Actually, it's a double low. We had this low on Monday right here, and then we had a corresponding low that happened yesterday, right at the same level. So at that time, the price moved below a swing area. I'll look at more of that on the 4-hour chart in just a second. But the ability to hold that level yesterday was key. You always want to see the price hold a low or a previous low, and the low for the week. That's even better. You see this blue line right here. This blue line represents the 100-day moving average. And technically speaking, typically when you have the 100-day moving average in play, the market traders like to use that either as a support or resistance level or a springboard to higher levels or lower levels. In trading this week, the springboard on the break above the 100-day moving average didn't do much here, didn't do much here, didn't do much here, and here. Right here, the price traded above and below it, but then decided to spring to the upside, creating our new high on Thursday's trade. We had to go somewhere, didn't we? The range was less than 75 pips at that point. But we came up toward this previous high from, I guess, last week's trading and found willing sellers against that level, forced the price back to the downside. The good news from a technical perspective, for the buyers at least, is that we're above the 100-day moving average. We're above the 100-hour moving average. That's this line right here. And we're above the 200-hour moving average. That's this line right here. So this area right through here between the 100-hour moving average, 200-hour moving average, inclusive of the 100-day moving average, is going to be the key barometer for both buyers and sellers next week. The battle is going to be determined at this line in the sand right here. If you stay above it, it's more bullish. If you move below, it's going to be more bearish. That's just the way it is. So now, of course, we kind of whipped around it above and below those levels in trading this week. But at some point, the market's going to decide which way it wants to go. Right now, we're heading into the weekend with the bias more to the upside because we're above those moving averages. We need to get above these highs from last week and this week to increase the bullish bias. If we're able to do that, when we start to look toward this high right here, which I guess is the high from the month of July. Taking a look at the 4-hour chart, we can look back at that swing area that I referred to, and this goes back a long way back through here where we had different support levels right here, fell below that level, he tried to use it as support here, then fell below it, used it as resistance. It wasn't perfect, but there was some consistency of using that level either as a support or resistance level, so pay attention to that as well. If we do break below the 100-day moving average, break below those moving averages. So there you have it. A look at the dollar versus Canada as we head into the weekend and look forward to next week. My name is Greg Michalowski. Good fortune with you trading. Bye-bye now.